Hello everybody, this is another in the series of video library series for members, and today's topic is trading on multiple or different time frames. And what we're looking at when we're looking at this subject is, how and why would you want to trade on multiple or even on different time frames? If we step back and talk about what is a time frame, a time frame typically is a daily, weekly, or monthly. Now, you could have an infinite number of time frames, but it makes no sense to do so. So technicians typically look at three. And historically, that's been daily charts, weekly charts, and monthly charts. And when I'm saying that, I'm talking about the daily bars. In other words, each bar on a chart is equivalent to one day. And if we looked at, say, this chart, each of these bars is one day. It's on a daily time frame. And if we did it the same on a weekly time frame, it'd be weekly bars, so forth. And as you know, on the TA Today charts, we have exactly that. We have three time frames. You can pop them all up at the same time. And there's a good reason for that, and that is because it's a powerful way to trade. Now, 60 bars pretty much across all time frames. Why do we do 60 bars? Well, it's not a magical number. I mean, if you count these, you're always going to find 60, assuming there's been at least 60 bars traded on that time frame. New IPOs might have 20 or something until they get farther out in time. But 60 isn't magical. 60 is the number. When I was doing the research and developing the model, 60 was about as much data as I could handle. In other words, in about 60 days, things back here are not going to be nearly as important as they were previously. And so they kind of fall off the left side of the chart. You don't see them anymore. And if I'm on the weekly, of course, when they fall off on the daily, they still will show up on the monthly. Same thing on the dailies, right? Now, the monthlies aren't going to show anywhere, but we're talking 5 years when you go back 60 bars on a monthly. So 60 bars is kind of the magic number that we use. All the charts are driven around those 60 bars. Now, each of those time frames that we're looking at, there's some value to them. And if we come back here, is that when we look at these three, we're not looking, which most technicians look just at the daily. We're not looking at just the daily. We're looking to see how this stock is trading across these three time frames as a whole, not just one, but all of them. And so when I'm looking at that, I'm really looking at it from the perspective of two things, right? Because everything in neoclassical is driven by trend and is driven by supply and demand as we see it on the charts. Trend exists on each time frame. We see it on each time frame, and it may or may not be the same on the different time frames, and that's why you look at all of them and potentially trade them all. For example, if I look at Starbucks and I look at it on the daily time frame, I can see the trend right now. The last transition here was bullish. And matter of fact, if I look back, there was a bullish transition here, another one there. This one actually went over some high that has fallen off the chart. There was a bullish one here, and it went sideways there. This breakout was a signal to potentially get into this, and it certainly proved that to be true on the retrace on this time frame. Now, when we look at it on a weekly time frame, it's a slightly different picture. It's been bullish for a very long time. This went bullish on a weekly time frame way back in November of 2014. So it's been a long time that this thing has been on an uptrend, and as you can see, it's moved from roughly, $40 up to $50. So it's had a 25% gain now over a 6-month period of time. And if we bring it back to the monthly chart, we can see it moved to bullish, oh my goodness, way back here. So this thing has been bullish for a very long time. In other words, it's been bullish since 13 bucks, and it's at 51 now. So if one were to be trading on the long-term time frame, there's still nothing here to tell you this thing is no longer bullish. It's been bullish for a very long time. So you know that you've got a long-term bullish trend in effect. You know that the weekly, the intermediate term time frame is also bullish, and you know that the daily time frame is bullish as well. But just knowing the trend doesn't really tell you how to get in and out. Supply and demand is what does that, and supply and demand exist on each time frame as well, and it's also not necessarily the same on each time frame. Now, supply and demand, as you know, is denoted by these zones. When we have an anchored zone, that's telling you should expect either supply if it's red, and we don't have any supply on this particular chart, or demand if it's green. So in other words, as it retraces back into that green area, you should expect buyers to show up. And in fact, buyers did show up on this time frame. And if we look at it on the weekly, actually let me grab the weekly, it also has time frames. It also has supply zones and demand zones. And the demand zones in Starbucks happen to be the only thing that's there. There are no supply zones. It's been that bullish. And so I know that as this thing retraces back in this area, I should expect buyers to show up and begin to buy it. So now what's the significance of these bars? In other words, I would use this as a timing mechanism to know when to buy, when to sell, if I'm trading across multiple time frames. And let me not get ahead of myself, so let me talk about that for a second. Since that's really kind of what this whole video is about, and that is that one of the powerful trading strategies, especially for long positions, is focused around this trading of multiple time frames, not just one. And the principles associated with it is you establish some sort of a core position, and you do that at some point in time. As the price pushes in your favor, right, you sell some of those. So in other words, if we come back, like for example on Starbucks, if we come back here and we're looking at this and we see it here break out, push higher, right, we might want to sell some into that push. And there's some ways that you do that. And as you know, we can do projections. And there's other videos that look at projections, but in this case, let's just do an ABCD projection, right? We had an ABCD projection. It projected to about here. And on earnings, this thing went much more over that. So you get a nice big push up. You go over your projection. If you had a core position, you might want to sell into that strength with the ideal of eventually, even if it goes higher, eventually catching some sort of a retrace and buying it back. And so the ideal here, of course, is that you buy and sell with the ebb and the flow of the position. So you don't sell everything. Let's say you had 500 shares. Well, maybe you reach up here and you sell 150 of them or 200 of them or some number of them up at that level. And then as it retraces, depending on whether you think the long-term position is really strong or not, you buy back at least that amount or you buy back even more. And so as it pushes in your favor, you sell some. As it retreats against you, you add back that position or even more. And again, if that long-term prospect still looks good, then you would slowly try to make that position size larger over time. For what? Because you're wanting to see this break again and go even higher. So you're wanting to see, the same scenario that you saw back here. You got a breakout. If you sold and then bought your retrace and you bought more, maybe you sell a little bit more as it extends, somewhere up into test this area. Maybe you would have sold it here if you thought it wasn't going to break out. You don't sell as much. You're keeping a larger and larger position, right? So you had, 300 shares. You sold, you sold 100 here. You bought 200 back. So now you have 400 shares. As it goes here, you sell 100. So now you've only got 300 again. It pops out. You go, oh, well, I'll sell another 100. So now I'm back to the 200 I started with. As it comes back, I buy those 200 back. So I'm back to my 400 and what? I'm looking for it to break out again. Now, more than likely, when it comes up the next time, it's not going to break out. I mean, it could, but given how this retraced, it probably won't. And so you're going to want to sell off 100 of those again and only have 3. And as it comes back, maybe you buy 200 again. So now you're back to 500. And maybe that next time up, it breaks out. you sell 100, now you have 400 left. And you can see how you build it over time. And you do that as long as the supply and demand equation continues to look right, and as long as the trend itself continues to look good. Finally, if I come over here and look at this from the perspective of, how do I make those decisions on how strong that supply and that demand is, the key thing to do really, there's two things. One is you can look for overlapping areas of supply and demand across the various time frames. So in other words, if I come back to Starbucks, I can see that the demand equation here, it runs from about 46.80 or so, it looks like this low, which is what, 46.70 roughly, up to this high almost, or this one, and that's about 49. So about 46.70 to 49 should be a pretty strong supply or demand equation. Now if I go to the weekly, I can see that this area here is about 49.43 all the way down to 46.68. So I can see that they overlap, and I can see how much risk there is here on this time frame. I should expect that there is a possibility that this stock could trade back to here and there would be nothing wrong with it. And so whatever my trading strategy is, I want to be able to buy again when it gets back down here, as long as I don't see volume rise tremendously, as long as I don't see anything extremely negative taking place in that stock. It could just build out a large range now and go consolidate. I mean, look back here on this weekly time frame. You had support way back here and it came all the way to it. And if you were trading just the daily time frame, you would have gotten stopped out, you wouldn't be in it anymore, and who knows whether you would have got back in or not. And so the ideal is look across multiple time frames and see how this lines up in terms of support. Anchored buyers across multiple time frames. The other thing to do is to look at the significance of that supply and that demand equation on certain price points based on what those anchor zones look like, what they're constructed from. And what I'm talking about here, let's just use this one. If I'm looking at this area, and let me just draw it out. If I'm looking at this area, I'm saying, okay, what is significant in this area? What are these zones made of? Well, there's this breakout that took place on huge volume. That's a good thing. It left volume at the top. That's also a good thing. So that says that more than likely we're probably going to head higher. We're going to come up here and test this at some point, most likely. I also can see that we had good volume back here on this breakout, right? When it broke out here, right, we had volume escalation on 2 bars. That was a nice break. And then when this broke out, if I measure it, this bar had 22 million, this bar had 22.2. So it had a little bit more volume as it broke out. So when it does that, right, once again, oh, and actually I spoke wrong earlier. This swing point was this swing point high. This transition was based off of this swing point high. This transition was based off of that swing point high, not some other one. This actually is an all-time high. And so anyway, when I get back to my point here is that, yeah, it broke out on more volume, but just a little bit more. So that says, okay, maybe we're not getting a rush of new buyers, right? There's some huge escalation in desire to get in, but instead as much desire to get in. So when it retraces back, right, how does it retrace? We don't see an increase in sellers, and it comes back into what kind of a zone? A fairly strong one, because you have some very big bars here. This is a retest regenerate zone as well, and there's a lot of demand at this level that we have seen before. And as prices come back into it, we don't see the level of selling. That says that those who ever bought, those large buyers, they're not willing to sell it here. If anything, they're going to buy some more. And they probably did buy a little bit more in this area, or maybe they're waiting to buy more here, or maybe even down in a stronger area, which might be this area. And it didn't quite get there, right? Because here you have overlapping bars, big volume, and they overlap with the low of this bar, which was big barring, right? This one. And so this area down here should be very strong. And so if price gets there, you should expect buyers probably to come in, whoever it was buying before, unless something fundamentally has changed in this company, more than likely you should expect them, based on the way these bars are lined up, that should be a very significant support zone in that price zone. 49 bucks, about 49.20. And once again, if we go and we measure it across on the other time zone and say, where's 49.20? This big bar, 49.60. The low of this breakout bar, 47.70. So yeah, there's some overlap here as well. That to me is how you line up, whether or not you believe this thing's going to continue and how much you buy at what price points. You look at the significance of those zones and the overlapping on the various time frames. Okay, so the ideal here, of course, in neoclassical, we're interested in trading around some core position over some period of time. And as long as that core position continues to look good, then we're going to want to trade it on the daily, the weekly, and potentially even the monthly time frames across different multiple time frames using a core position and trading around it. I hope that's informative and helps you some to think about trading in a different light. I think it's a very powerful way to trade the long-term positions. On a long side, short trades are a little bit different, and you have to look at them a little differently. But on the long side, this is a great strategy if one wants to stay in a position over time and trade around it versus just buy it and watch it go up and down, up and down, up and down, and eventually go higher. You can make that position larger while you're waiting by using just neoclassical principles to sell and buy depending on where the demand zones are and the supply zones, the selling zones. All right, thanks a lot. Take care.